everyone, and welcome to our presentation today, which is going to be generally on Inheritance Taxes 101. We're going to be going through a couple of examples on the most common types of assets that people are really concerned about when it comes to inheritance taxes, and then just generally talking about some other things that you'll want to be aware of with transfers post-death, and also between certain parties as well. Today, as my special guest, I actually have Dan Griffin, who's also my husband. You probably have seen me on this channel before. My name is Alyssa Chow. I do a lot of presentations related to estate planning, so I'm an attorney who drafts wills, trusts, powers of attorney, and all of those fun estate planning documents.
And just for myself, my name is Dan Griffin. I'm a partner at New Point Law Group over in Roseville. We primarily handle tax disputes and tax litigation. We also help out with business litigation and drafting documents, document review as well.
Mm-hmm. Yeah. So Inheritance Taxes 101. Next slide. Oh, yeah. So my firm, I'm located here in the Sacramento area. I do practice in a lot of different counties that are in the surrounding area. Thankfully, there's a lot of things that we can do remotely nowadays, and so I don't only practice in Sacramento, but that is primarily where I'm at. And in addition to the regular estate planning documents, I also do provide services in conservatorship and other general probate-related needs. And a little bit more about me. So I've actually been volunteering with ACC for a pretty long time. I was volunteering all the way back when I was in high school, and I've also been volunteering at various events that ACC holds in more recent years, like the crab feed or things like that. As well as in the community, I'm also on the board of the Sacramento Asian Sports Foundation, and in my capacity as a board member, but also vice president and secretary.
And just about me personally, so I grew up in the area. I was raised up in the Roseville-Granite Bay area, went to college in Chico, and actually have my second degree black belt in martial arts. As far as community connections, I'm actually involved with the Basket Brigade, which is slowly making its way from Chico all the way down to Sacramento over the years. And what we do is we actually serve people who are not able to get dinners for one year or another during the Thanksgiving season. So that's part of my community involvement. I love being connected to this community. It's been wonderful getting to know the Sacramento area and everyone around, and I really appreciate being here and being a part of the ACC community for today.
Yeah, and I always have to give a shout out to my mom, Sue Chow, because she is an avid pickleball player and she demands that I give her a shout out every time I present here. So you may see her out on the ACC pickleball courts. And I don't know, Dan, have you been on the ACC pickleball courts yet?
Not the ACC courts.
Okay, she's probably going to drag you out at some point. But Dan is also a pickleball player as well, so you might see him over at Lewis Park here. Okay, so for the purposes of today, just to jump right into it, we're going to be talking about some of the more common tax issues that come up with transfers post-death. The three categories that we're going to be focusing on are going to be one, estate taxes, two, capital gains tax, and then I'm going to be talking a little bit more about property tax and Prop 19, which is a recent law that went into effect last year. Some things we're not going to be talking about, though, are going to be, if there's any specific estate planning documents, because you can really get into the nitty-gritty of different, more nuanced rules. For the purposes of today, it's really going to be more general rules. And we also do have some links down below. So after the presentation, I believe ACC, they do make these slides available. And so if you're curious to learn a little bit more about some of the topics that we're covering today, then you can just click on those links or follow those links and get a little bit more detail.
So let me go and kind of jump in here. Whenever we talk about tax, one of the fun parts is you're really talking about two separate systems, very broadly. There's federal tax and there's state tax. For state taxes, we're really only talking about federal taxes. The federal government is the only one who gets to step in, and if there's an estate that's large enough at the time that someone passes away, that's when they can go ahead and tax on the using the estate tax. For capital gains, that's for everyone, and there are primarily federal capital gains taxes. California, it's a lot simpler. Everything that comes into your pocket is taxed pretty much the same. But capital gains taxes under the federal system is what we'll be covering today. As far as kind of common types of property that we're going through, we're really focusing again on cash, stock, and real property. Cash is going to be very simple, and we'll cover that closer to the end. You really only need to talk about estate taxes when it comes to taxes. When it comes to stock or real property, there's a lot more nuance, and that's going to be the majority of what we'll be talking about for this portion. As far as real property goes, let's focus on capital gains. The way real property is taxed changes depending on where you're at and what stage you are in your life. It also changes depending on whether you're the original owner or whether you are the beneficiary after someone passes away and leaves you property. I like to take a step back on capital gains tax with real property and just really focus on what happens before, when one spouse passes away, when both spouses have passed away, and then finally what happens with the beneficiaries, because everyone has a different concern and there's a different kind of formula at each stage there.
Mm-hmm. Yeah, so maybe let's talk a little bit about what happens when both spouses are alive when it comes to real property.
Sure, so this is, most common. What happens if Alyssa and I bought a house since we're married together? What happens if you buy a property with your spouse? At the time you buy the property, you lock in what's called your tax basis. That is the amount that is not going to be taxable. And if the property goes up in value, you have a certain amount locked in for tax purposes. One of the main things that I hear from people, and one of the main questions is, well, what about my loan? Sorry, loan doesn't count. It's only that purchase price at the very beginning. Mm-hmm. As you go through life, you may wait 5 years, 10 years, sit in your property, and you may decide to sell it at some point. Let's say you buy a home at $100,000, so that's your basis. At the time you sell it, you have a sales price of $600,000. It looks like, at first blush, you have $500,000 in gain. It's a lot to get taxed on. But when it comes to real property in particular, the thing you're going to hear me say over and over again is there is a primary residence exclusion of $500,000 for married or $250,000 for single. That is the biggest gift we're going to get from the federal government at any point. That's why a lot of people like using houses for creating and generating wealth. Mm-hmm. So we can go back to buying a property for $100,000. You sell it for $600,000 while you're alive. The formula is $600,000 sale price minus your basis of $100,000, so you're left with $500, minus $500,000, which is the exclusion, you're left with $0 in capital gains there.
Which is awesome.
It really is. I mean, it's the biggest point that you will get for transferring wealth is having the exclusion at some point besides the next point we go over a little bit later.
Yeah. So what happens then if you sell and there actually is a gain then, or how do you calculate that?
Sure, so same formula. Let's say you bought it for $100,000. You sell it for $800,000 after sitting around for 5 years. $800,000, that's your sale price. Minus that $100,000, you're left with $700,000. Minus $500,000, which is your exclusion, you're left with $200,000 that you're going to get taxed on. Mm-hmm. The rates change as far as how much you're taxed. But you actually have a gain at that point, and that's if you're still alive. So we'll stop at that one because that's mainly what happens with people while they're alive is they wait until the property appreciates in value, goes up, and then they sell it for a gain, hire someone to do the math for you, make sure you get all of your tax savings in there as much as possible. Then that leads you to whether you're going to get taxed or not.
Okay. And then in another situation then, so in this hypothetical, we're using the two of us as a married couple as an example. What happens if I pass away?
I thought she was going to take me out, but sure. So what happens
I'll take the hit on that one.
She passes away first? So we bought a house together. Bought it together, lived together. What happens then? Well, I have a couple of considerations now. If we go back to what's the focus here, there's two taxes now. There's an estate tax, which is the taxes applicable when someone passes away. And then there's what happens with the real property or with other property with me as the beneficiary, the person who's getting it. From the estate tax side, here's the good news. Most recent tax law has just increased the baseline for when you get taxed up to over 12 million per person. It's 25 million when you get up high, 24 million when you get married couples. Less than 1%, less than 0.1% of people are going to have to deal with the estate tax. But if you're very fortunate and Alyssa keeps, grinding away and she leaves me with $12 million, $12,500,000, I'm going to have to pay estate tax. Otherwise, I'm not even going to have to worry about it. But let's talk about the house, because that's probably the biggest thing that's going to come up, right? And with the house there, if we bought it together, she dies, what happens if I want to, for example, sell it right away? I want to move out. Well, we bought the house together for $100,000. She passes away, and what happens is we lock in that price of when she passes away. It's called a step up in basis. So she dies, and the house is worth $600,000. I want to sell right away. The house is worth $600,000. So what's my formula? Instead of it being $600,000 minus $100,000, what I purchased for, it's now $600,000 minus $600,000 with the step up in basis. That means I don't even have to use the exclusion. It's $0 right there. No capital gains for me if I sell it right away.
Yeah. So what if you wait a little while and then the property increases in value?
Sure. So similar, bought it for $100,000. She passes away. It's worth $600,000 at the time she passes away. But I wait for a year and I live in the house and I decide, you know what, I want to wrap things up, whatever happens. After that year, property is now worth $800,000, so different sales price. Formula becomes sales price, $800,000, minus the $600,000 from the step up in basis, the value when she passed away, minus my exemption with the federal exclusion for primary residences. That means I still have $0 in capital gains, so I still don't have to worry about it yet.
Okay.
The last thing to note is, again, if it goes up an incredible amount of value, or what we see a lot, and this is where we really start to weigh in with our firm, what happens if you wait 10 years, 15 years, 20 years? What if you get remarried? We're not going to go over all those, but the general idea is, one, you may lose the married federal exclusion and it may get reduced. The other thing is your property value may keep going up, 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 and you may have an issue with wanting to sell a house with a very high value when your stepped up basis only covers some of it and only saves you some tax. So it's something to be aware of, is planning out when you want to sell a home.
Okay. All right, and then what happens when both of us are gone?
Sure. So if we have kids or if we have beneficiaries, they're going to be asking these same questions. What happens with estate taxes? What happens with capital gains taxes? This is really the focus for today, and this is probably where Alyssa, sees this a lot, but from the tax side, what happens? We've both passed. That's one side, is the estate taxes. For estate taxes, we go back to what we talked about before. You have $12 million for an individual, or if she passes away and then I pass away later, or if we pass away around the same time, you're really talking about $24 million in exemption from estate taxes. Most people don't have to worry about it. The estate is created by looking at everything you have. That's your house, stock, that is cash, that's a vehicle. If all of that together is worth more than $25 million, that's what you're really talking about for an estate. And whether you get taxed on it is whether the estate is worth more than that threshold amount, that $12 million for single, $24 million for married. But that's not most people's problem. Right?
Unless you play the Powerball and you win the lottery.
That's what we can hope for.
Yeah.
But for most people, it's really about real property, stock, or cash.
Yeah. I think most common for me, so, because I'm an estate planning attorney, I also assist with post-death administration. One of the most common questions that I get from family members is, what do we do with this property? You know, do we sell it? Do we hold on to it? If there's multiple people who are inheriting, you know, what are the consequences for all of those people? And so Dan, you know, here is somebody that I would then refer them to to talk through what those actual consequences are. My role as the attorney is to walk, you know, whoever the person is in charge through, you know, the actual mechanical steps that they would need to follow in order to get to the point of either being able to sell or transfer the actual property. But ultimately, if they do decide to sell, then I send them over to Dan.
Absolutely, and they each play off of each other very closely, which is one of the benefits to knowing someone in both fields. You may have an issue in one, need to talk about the other, and that's where it really helps to make sure you have the proper person handling the right type of issue. And so when you talk about the other side of the equation, what happens when we both pass? You have a piece of real property is the most common one. That's the one people are usually most worried about. At that point, you've bought a home for $100,000. Both of us have passed. Now the property is worth $1.2 million, so a huge increase at the time that you've passed away. And our kids inherit it. Ideally, they inherit it through a trust, which we can talk about at a different time, but they want to sell it immediately. As soon as they get authority, they say, hey, I want to sell this right now. It's worth a lot of money. You know, what is it worth? Well, we go back to our best friend, a step up in basis. House is worth $1.2 million at the time we passed. They sell it immediately for $1.2 million. There's $0 in capital gains. That's a lot of money that you don't have to worry about from a tax perspective.
Okay. And then what happens if they wait a while? You know, it's not uncommon that maybe they don't have a trust and they have to go through a probate administration, or something else happens where everyone's fighting, and so no one can agree on whether the house can be sold right away, or even on even right now, I would say, you know, the market is kind of terrible, and so some people decide to wait. Maybe 5 years go by and they finally get to a point where they feel comfortable selling the property.
Absolutely, and that's probably the most common where we would both see something like that in our practice, is what happens when they wait, what happens when there's a fight. Exactly right. Bought it for $100,000, worth $1.2 million when we both passed away. Our kids get locked up because they don't know how to find our trust, or they don't hire the right professional like Alyssa to help them through it, and so they get stuck. What happens as the property goes up, up, up? Let's say the property is worth $1.6 million. And we only have one child, just to make it easy. And that child is married. Here's where there's a little bit of nuance here. I'm going to make it easy and say they move in. Because if you remember the name of it, the primary exclusion is for primary residence exclusion. That's how you get that additional tax savings besides step up. So it's worth $1.6 million. Kids are married. At the time of death, it was worth $1.2 million. They're still, you know, it looks like there's $400,000 left, but since they're married and it's their primary residence, $0 in capital gains. It really is one of the best ways to pass on wealth through that, and planning for that is really a large deal from a tax perspective. If your child is single, they can still save a lot of money through this process. Property's worth $1.6 million, worth $1.2 million when we both passed away and our kid gets it. They live in there as their primary residence and they're single. 1.6 minus 1.2, you have 400,000. But instead of getting the married federal exclusion of 500,000, they're only allowed to get 250. As a single person, you're only allowed to have a primary residence exclusion of half the value. And so you're still left with 150,000 to be taxed on at the capital gains rate. It's not the worst thing. You swept most of it in without tax implications, but there's still a little bit you would need to pay tax on.
Bottom line, it sounds to me though like if you're going to be inheriting real estate, it's a good idea to talk to a tax professional to try to plan it out in a way where you can minimize your potential tax burdens, especially if you're not planning on selling property right away.
That's absolutely right. And part of what comes into our analysis is timing the market, or understanding what the gain was, or proving that the dates that there's a step up in basis is established, so that when the IRS has a question and they wonder, hey, what happened to your $1.6 million property with your parents, you can tell them, no, don't worry about it. There's a step up in basis, and you run through the math with them. It's usually pretty easy to clear up, but we mainly hear these issues at the time when you file returns, or when the estate files a return, or when the IRS sees some type of 1099 and they start asking questions.
Yeah. Okay. So we've pretty much covered a lot of different scenarios when it comes to real estate, but then what about something like stock?
So stock is treated in a similar way, and you're still talking about capital gains. So we're still in the same universe. But with stock, it can't be your primary residence. So that's the one thing that changes is you buy stock for $10,000. It's worth $20,000 when we both pass away. Kids ask, I want to sell it right away. What does it look like? Well, step up in basis, 20,000 in stock, minus 20,000 step up in basis, you have $0 in capital gains.
Okay. So that's real estate, that's stock. What about cash?
Cash is the easiest. You really just deal with the estate tax. And so unless you're leaving just this mountain to your kids, it's really not an issue that comes up very often. The only thing I'll note, this is a little bit outside of today, but the only thing I'll talk about, and this is why it's so important to hire a professional from an estate planning perspective to quickly administer the estate, is if the cash sits around for a lot of time, you may be issued a K-1, which is a tax form, to talk about your interest income. If it sits around for a year and it earns $1,000 in interest with the cash sitting in a savings account or checking account, you may get a little bit of tax from the cash sitting there. Otherwise, if you deal with it quickly, it usually doesn't come up very much.
Okay. Yeah. So do you have any, I guess when people contact you, what are some really common situations? We've talked about real estate, we've talked about stock, we've talked about cash. What is, I guess, the most common situation that comes up for you?
You know, we kind of touched on the most common situation, which is the most common one is when someone's selling a house that belonged to their parents. A lot of the dispute that comes to us is the property value at the time that they passed away, to save and talk about whether there's a step up, step down in basis, whether the property value was worth more or less. That's usually where we get involved.
Okay.
So a lot of our values in connecting with real estate professionals who can value the property, or with talking to the IRS and talking to them in a way that will minimize cost. So you're not going back and forth and having to do an audit with those principles. That's mainly where our firm gets involved.
Okay. Yeah. It's interesting because from my perspective, again, as an estate planning attorney or someone who does represent successor trustees or executors, or just personal representatives in possibly a probate case, all these tax issues are sort of floating out there, and it's definitely on everyone's mind, and it's something to definitely be aware of, right? You're not just getting everything with no care in the world or no potential tax issues that are going to come up. And so even, I talk a little bit about this in one of my other presentations about what you can expect if you are in the position of a trustee or an executor, and how some of these things you really have to be aware of or on the ball for, because you don't want to end up in a situation where, let's say there is all three of these categories where you've got a house, you've got some stock, and you've got cash. You sell it, you don't even think about the tax consequences, and then you distribute out to all of the beneficiaries. That's the worst case scenario, because then you don't have any money left, you've distributed everything out, and you've got a big tax bill that you're going to get hit with later, possibly, right, if you fall under that category.
Absolutely. And one of the differences with preparing for tax implications is there's different professionals. Always reach out to a broad array of professionals, see if they're the best fit. Sometimes you want, for example, a tax attorney like me who would be able to help you out with taking a position or litigating an issue. Sometimes you don't need to go to an attorney, though, and there are other professionals for different types of issues. Connecting with someone like Alyssa who can help you walk through that, connecting through a tax attorney who can help walk you through what's the right connection for your particular issue. That's where we try to deliver a lot of value between our professions.
Okay. And then the last category that I want to talk about is something that really comes up more so in my practice area, which is related to property taxes. And I don't know, do you guys handle property tax issues very often? We
do, but I would say that Alyssa's the exact right person to talk to about this. She deals with it in a masterful way, so she's a really good resource.
Oh, thank you. So on the screen, you'll see a basically just a photo that I took from the BOE website, but this actually has to do with Prop 19. And so as you can see there, it's basically a spreadsheet, a column, and you can find this directly on the BOE website if you just Google Proposition 19. But essentially back in November of 2020, California voters did approve Prop 19, which was also referred to as the Home Protection for Seniors, Severely Disabled, Families, and Victims of Wildfire or Natural Disasters Act. Now, I'm not going to be touching on the majority of those just because it doesn't directly relate to inheritance or transfers of property between family members or beneficiaries. But I will be talking primarily today about the parent-to-child or the grandparent-to-grandchild exclusion. When we're talking about property taxes, a lot of people are really concerned. Let's say, Dan and I pass away and we have one child and they're going to be receiving our primary residence as their inheritance, right? Maybe when we purchased the property, we had a really low property tax basis where our property taxes that we pay for are, a couple $1,000s maybe per year, or maybe $1,000, let's say something crazy, right? Like $1,000 max per year. And our child is curious, well, if I'm inheriting this property, I need to know that I can actually afford to keep the property. And part of that calculation is considering whether I can afford, or our child can afford to pay for the property taxes. What a lot of people don't realize, and a trap that some people fall into, is that if they're inheriting real estate, they don't alert the assessor that the owner has passed away. And so if you're not alerting the assessor, then they don't know whether the property taxes need to be changed. Now, this is all effective as of date of death. So whether you wait 10 years or you do it right away, the property taxes, whatever the new amount is, if there is a new amount, that's going to be effective on date of death. So you want to be really proactive in considering whether or not you can avail yourself of the benefits of Prop 19 or not. So just to give you a quick example of, or I guess a comparison of what things were like pre-Prop 19 versus how it'll basically work out now that Prop 19 is in effect, is essentially that anybody who passed away before February 16th of 2021, there was almost an unlimited, I don't want to say entirely unlimited, but for transfers of a primary residence between parents and children, or of a primary residence between grandparents and grandchildren where the parent in between has passed away. In those situations, you could essentially inherit that primary residence of an unlimited value and keep the same property taxes that your parents were paying before. There was really no limit there. And then if there was any rental property, you were limited up to $1 million in assessed value, essentially, or up to a combined value of a certain number. There's a threshold number there, and you could inherit that property and basically avoid paying additional property taxes or a higher property tax rate than what your parents were paying. Not so much anymore. Basically, anybody who passes away after February 16th, 2021 now, if there's a transfer of a primary residence, you're limited to up to $1 million in assessed value. The assessor comes up with that assessed value. And it's not only that it's a primary residence of the parent, but in order to qualify to keep your parent's property tax rate, the inheriting child has to also plan on using the property as their primary residence. And the way that the assessor tracks that is that the child has to qualify for the homeowner's exemption. And you only qualify for one homeowner's exemption. So you can't pretend or try to make an argument that it's a second home and have two homeowners exemptions on multiple primary residents. You just get the one. So I like to give a couple of hypotheticals. I really do apologize. We've been talking tons of numbers today. And so if anybody has any more specific questions later, the two of us are happy to chat with anyone after this if they have questions. I would recommend you actually reach out to us directly because these tax issues can be really specific. But the hypothetical that I like to give is, let's say that we had property that we purchased two properties, let's say. So one in Sacramento, one in San Francisco, two really different markets, right? Let's say we purchased those properties for $300,000 each, and we create a trust, we put those properties into our trust, we name our child as the successor trustee, and both of us pass away, right? Theoretically, if both of us had passed before February 16, 2021, and if we were to leave property, let's say in this situation we have two children, right? We've got a son and a daughter, right? And we, in our trust, say our daughter gets the primary residence here in Sacramento, and our son gets the rental property in San Francisco. Assuming that those properties have increased in value over time, the property taxes could be significantly higher. Pre-Prop 19 for the primary residence, as long as it actually didn't even matter if our daughter decided to live in that property, right? As long as she's receiving that property, she would be able to keep the same property tax rate that we were paying before. Same thing with the property in San Francisco. As long as it's no more than the assessed value that the assessor would look at, then our son in that situation wouldn't have to worry about an increased property tax on that property either. Now, slightly different situation when it comes to post-Prop 19. If we both had passed away after February 16th of 2021, it's a completely different outcome for each child. So let's say for the primary residence that we leave to our daughter, if it was worth $300,000 when we purchased and we had a pretty low property tax rate, as long as we were using it as our primary residence, and as long as she intends to use it as her primary residence and she qualifies for the homeowner's exemption, then assuming that the property hasn't increased in value over $1 million in assessed value, then she gets to inherit that property and keep basically the same property tax rate that we were paying before. Slightly different situation for our son though. So if he's receiving property in San Francisco, which I'm going to tell you, if somebody purchased property for $300,000 and then many, many years later passed away and there's that property in San Francisco, I mean, it's probably worth well over $1 million now, right?
Oh, yeah, absolutely.
Easily. But unfortunately now, post-Prop 19, our son's not going to get any exclusion from reassessment. So essentially what will happen then is the assessor will do a new assessed value as of our date of death for that San Francisco property. And when he receives the property, he has to make a decision whether he can afford to even keep the property. Because essentially then, moving forward, let's say it does get reassessed at $1.5 million, the property taxes on that are going to be astronomically higher than what we were paying at a $300,000 rate. And because Prop 19 is in effect now, he's going to have to worry about paying that. He doesn't get any of the benefit that our daughter would get for a primary residence, purely because the rental property, it doesn't qualify under Prop 19 as far as inheriting that. So incredibly different outcomes. And so it's really important that if, sometimes I have clients who have set up a trust and they do have something where one property is allocated to one child, one property is allocated to another. It's a really good idea to revisit that to see whether or not you're putting one child potentially at a disadvantage. Now, to be fair, if our son is selling property and let's say he can't afford to pay the property taxes at the increased rate, he's probably still getting a little bit of a higher benefit anyways with when you calculate in the taxes, because San Francisco property is probably worth incredibly more than Sacramento property. But at the same time, you want to make things as fair as possible if that's the ultimate goal for your estate planning. And so it's a good idea to revisit that and just make sure that with the change in the law, with considering the potential tax implications, that you're not putting your kids at an unfair, on unfair playing ground. But yeah. So, with that, that's pretty much the entirety of the topics that we wanted to talk about today. Like I mentioned, if you have any questions, we do have our contact information that's available not only through the presentation itself. Oh, yep, there it is right there.
There we go.
So I've got both of our separate phone numbers. We're in separate firms, even though we are married. It's a good idea that we don't work together in the same firm. But at any rate, if you do have any specific questions about the type of tax issues that Dan went over today, or if you have questions about estate planning or possibly property taxes for inherited property, either of us, we're both happy to answer those questions if you want to contact us directly.
Thank you for joining us, everybody. We really appreciate it. And thanks for having me on today. I really
Yeah.
appreciate you letting me join.
All right. Thank you, and have a good rest of your afternoon.